Hi, and welcome to a special weekend update. We're recording this on Sunday, January 10th, 2016, based on the closes into Friday, January 8th, 2016, because some of the movement was so radical, it warrants reviewing all of the evolution of the trends into Monday morning. So this is available well before the U.S. opens or even any of the European markets open. We do have some electronic trading in Asia already, though. And part of the reason we're doing this is the degree to which the bear market equity psychology and bullish U.S. and other fixed income psychology has even overrun the quite a bit higher than expected U.S. non-farm payrolls jobs gain from Friday. And what did all this mean to the markets? Well, it was very interesting that the S&P 500 was up after the Thursday debacle because the Chinese markets had stabilized and recovered from slightly lower levels after the Chinese lifted the trading curb trading restrictions and closed a bit higher Friday. Whether that was real or somewhat, shall we say, encouraged by the state, who knows? But what we saw is right after the U.S. employment report, the S&P 500 future electronically traded back up to 1964 temporarily. Now 1962 to 58 is one of those key ranges we had highlighted previous, and after gapping below the very important 1975 to 70 that the market held on Wednesday, gapping below it on Thursday and failing on that first rally on the squeeze above 1960 area back then, left the market under pressure Thursday. By the time we got to the U.S. actual opening, we had resistance based on this channel down into around the 1950 area, reinforced by this failure at 1952 on the Fibonacci retracement. You can see what we got to as a high, 1952, and then the market decided to start heading down again. Now, what is important about that is that we had highlighted this channel resistance as being levels at which the market was going to move $10 lower on the resistance every couple of hours. So 10:30 to 12:30, it was going to be around 1940. Most importantly, around 12:30 onward, it was going to be down to around 1930 area, which of course is another key interim support. Market held actually in electronic trading at the worst levels at which it came in, held near it on Thursday morning before this big rebound, held it late Thursday in spite of the pressure, and held it again on early Friday, but then couldn't reverse the trend. And this is the importance of knowing where the trend parameters are. If it wasn't going to close, not just trade, but close an hour above this channel, the bears still own the market, and the big question that we even posted on some social media was, is this market going to crack the 1930 area late in the day for another big spill? And lo and behold, it did. Now we'll see on the intermediate term charts, it's getting back down to more important interim supports starting at 1900, but also into levels like 1860. And that'll become very important as we see not just on those charts, but on the longer term charts. For right now, the trend remains down. Next resistance 1930 with 1950 and 60 above that. And that pretty much does it for the short-term view of the S&P 500. So with that, we are going to head over to the monthly chart on the S&P 500 and overshot it by one. And if you look at the monthly chart, we are seeing the failure up at 2015. We called the 2010 to 20 range for various reasons. Note that that channel, which was in place before the October 2014 Ebola scare sharp sell-off low, notice how that channel was in place. And as everyone was panicking here, we were saying, you know what, if it holds the 1800 area, it's probably still good, and snap back up once everyone realized that was quite a bit more isolated than expected previous. But on the push up in the early last year, we warned of problems from lack of structural reform. Out in May of last year, we warned about the fact tail risk was becoming more real. And after the mid-August FOMC minutes release, we said tail risk is now mainstream. And that was right before the pressure from the Chinese situation, interestingly enough. Back above 2010 to 20, getting out into October. Had to respect that. And now we're coming down again. Well, what does that mean? Well, that channel market held so well and held above going back into August of this year and held in October of 2014, August of last year. That channel is now up this month to 1864. You got that Fibonacci retracement at 1866, and you've got the September pullback low at 1862. Now, obviously, there is a buffer still into the low 1800 area from the previous trading. And we have to respect that, but much below 1860 this month, this market could go from bad to worse. If it holds it, as weak as it feels right now, it might just react back up to either the upper 1900s or somewhat above 2000, but we remain bearish overall. And that's the big picture.